Welcome back to Your Average Investor. Today we're going to be talking about updates on GameStop and AMC, as well as how we would recommend trading them. In fact, how we're trading them ourselves. Now, buckle up and get ready because this is wild. Should you buy the dip? Should you run and stay away? If you bought in early, should you sell? Great questions. Of course, as always, this is not investment advice and it depends on your own individual risk tolerance and portfolio. So let's dive in and hit that subscribe button if you haven't already. GameStop first, then we'll get to AMC later. The last several days have been an absolutely wild rush. If you need to get caught up, watch our past videos. You'll learn everything you need to know. This is what I'm seeing with with GameStop. Over here, if we rewind time all the way back here, we've got this very nice base that formed at this $36, $37 mark, right? You can make that maybe 36, 35, 37, right in that area. And if you'll notice today, that's currently where GameStop is hovering. It did dip down below, but it's come right back to where that base was, $36, $37 per share. So I would be interested to see if a base starts forming here that will create a new launch pad back up into the $50, $60 range. One thing I would absolutely stay away from right now are buying call options without any kind of hedge against the price. If you look at the premium here, right, this expires not this Friday but next in 9 days, and look at the prices on these. It's just absurd. If you wanted to buy a call 50, you'd have to spend $750, $760 for that now, which means the price of GameStop just to break even would have to reach $57 per share. Not undoable, right? I mean, in pre-market trading, it made it all the way up to $80 per share this last time around. So it could happen, absolutely, but time's not on your side there. So if I were to be buying calls, what I would look to do is maybe something like this, where I would purchase a call 38 and then sell a call 39, and this would cost me $15. And what that means is I have a max profit here as well of about $85. The way you do that is you take 100, which is the difference between the two strikes, 38 and 39, subtract the price that you pay, that will give you your max profit. Also, if you click the little confirm button, it will show you here too, max profit, max loss. Now this in my mind is a really good risk reward ratio. I risk $20 and I have the potential to 4x my investment, make a profit of $80. And in order for that to happen, GameStop just has to be trading at $39 or above by expiration. So that's the kind of trade I would be looking for if I were playing call options. Now, the other nice thing is both call and put options are super juiced right now. So let's say you wanted to buy more shares of GameStop, right? And let's say you were confident it was going to be trading above, we'll go $20 a share, right? Let's put a nice little price line here at $20 a share so we can see what this looks like. That's about 20 bucks a share, which was before this pretty nice floor. So I think you have a good chance that GameStop does not go below $20 a share over the next couple of weeks, but maybe it does. But in this case, the other thing I would look at is I'd just say I'm going to sell this put 20 for 100 bucks, right? Cash secured put right here. I'm going to make 100 bucks on that. And what I would probably do if I really liked AMC is I would turn around and take that $100 and I would buy 2 shares or 3 shares of GameStop. I would buy 2 or 3 shares of GameStop with it. So I'd say, all right, I'm going to sell this call 20 and I'm going to turn around and buy a couple shares of GameStop, because if the price of GameStop goes down to $20 a share, I'm willing to buy 100 shares, right? You need $2,000 to collateralize that. And then also I'm supporting the current price by buying shares at the current price. And of course, you can do that as many times as your risk tolerance in your portfolio allows, your capital allocation allows. So that's really interesting, right? Is because of the current massive implied volatility on the entire option chain, calls and puts, it's a really good time to be selling, in my opinion, selling puts. Now, if I already owned over 100 shares of GameStop and I hadn't sold covered calls, I would 100% be doing that today. No question in my mind. I've already sold a call. You guys already know if you've been watching, I'm stuck in this call 16. And I think there's a decent chance I can roll it up and out later, but I'm going to wait, give this a little more time before doing so. But let's just say I hadn't. What I would definitely be doing is looking at this 2 days to expiration option chain, and I would be selling something like a call 45 for 500 bucks. Or, you know, if you want to go even further out, call 50 for $400. This gives you incredible upside you're still getting massive upside here, and you're protecting yourself against further downside, or reducing your average cost basis by, however much in premium you're getting here. And if you wanted to go really crazy, right, at least collect $100 in premium. Like, look how far up you can go in the option chain and still get $100, right? Look at this right here. The bid on these call 89s is $105. And in fact, the bid-ask spread on these is so wide, you could probably get, my guess is you could get $100 all the way up to these call 95s. So I would be selling these call 95s for $100 if I had 100 shares, collect that premium, and just let it expire worthless, hopefully in a couple days. And if it doesn't expire worthless, you're up like almost 200% from, or maybe 150% from GameStop's current price. So that's one way I'd be looking at playing this. Now, of course, you could also look at long-term, just buy shares and hold, and I think we're in an interesting zone here. If there's a base that starts forming here at 40, or just under 40, I think there's a good chance that this pushes back up to 60 sometime over the next month or two. Now, it could break below again. I'd be a big buyer again if it came at $20. $20 or below on GameStop at this point, I think, is a just absolute no-brainer buy. And you just keep on DCA, dollar cost averaging down, in order to build up a big base. And then on any time it rallies, sell covered calls, collect that premium. And again, reduce your risk, right? So let's say, in my case, I actually did this. I bought 100 shares at $13 a share. It was a little more, maybe like 13 and a half. So we'll just call it 13.5. And then I immediately went around and I sold a call 16 for like $250, which means my break even is if GameStop dropped down to $11 per share, I would be break even. Let's say that call expired worthless, right? Or let's say I was a little more patient and I waited until today to sell covered calls. Well, I could then go and, again, sell one of these covered calls for $200-300, $500, maybe even $600-700. And let's say I've done this for a few weeks now, right? So I got my cost basis at 13.5. One week I sell for 250. The next week I sell another one for 350. Next week I sell one for 500. Oops, not like that. But it would bring my cost basis down to like 2.5 on GameStop. And then I've got basically a risk-free position. I could sit in that forever and not worry because I've pulled out so much money in premium. And these surges where the premium goes nuts is the perfect time to do that, because then you can truly be a diamond hands and just be like, look, I already pulled out all of my money, or the majority of my money, by selling covered calls, so I can just sit on my shares forever and I won't be losing money on it because I've already pulled that premium out. I think it's a no-brainer play. Again, not financial advice for you specifically. This is just me looking at it. It's what I'm doing too. Now, am I buying shares of GameStop here? No, I'm not. What I'll probably do, I'm going to look at my portfolio, see if I can allocate some things differently. I will probably end up selling some of those call 20s that I was just looking at for $100. And if GameStop drops down to 20, I'd be willing to buy a couple hundred more shares. So I'll probably sell a couple call 20s, maybe 3 or 4 at most, with that option to buy 100 shares for $20 a share. Because I think that is a phenomenal place. Look at this. You had a bounce here from 20 to 50, another bounce here from 20 to 43, and then a big base just above, and then it had a hard time cutting below. These were smaller bounces, but hard time cutting below. I think we'll see some similar price action for the next few months, and so that's where I'm looking at those put 20s as a really safe zone to sell in. Now, if you want to be maybe a little extra safe, you could even look at selling further out, right? I could go these call 20s for 250 to 300. The thing that I don't like about this, though, is I'm adding 20 days to my expiration and not getting that much more premium for it. This is how I like to look at it. So let's say I could get this for $275. I'm going to do 275 divided by 30. I'd be collecting $9 of premium per day. On the other side, right, is if I sold the call 20s that are 9 days to expiration for $100, 100 divided by 9, I'm getting $11 per day. So it's a pretty big difference. It's about 20% more per day in premium, based on the fact that if I sell here, then, and in fact, that's even more than $100 now. It's 111 to 119. So a little more premium there per day, even though it's less premium overall. And then when those expire worthless, if they do, which I'm assuming they would at this point, then I just go in and collect more. And again, if you want to, you can just turn around and start buying the shares of GameStop with that premium, but even if it doesn't dip, right? I can get 2.5, almost 3 shares. If I get $110 of premium, I need like 140. So maybe you look at it that way, right? If I sold right here, this 21.5, that'd give me about, if I could split the mid, get $140. I could get 3 shares of GameStop by selling that call, that put right there. And again, you got to be careful there because you want to make sure you have the capital to collateralize. If by chance GameStop does trade below $21.50 per share, you are going to be on the hook for buying 100 shares at that price, 100 additional shares. So that would, that'd cost you $2,150. Here it'd cost you $2,000. And, down here, nobody's even willing to buy those, or that's why there's no bid. But, you could theoretically sell these put 6.5s for a penny, or maybe these, you could go these put 10s for $4 and, or $6, $6, and then you'd be on the hook for $1,000 if it came down to that price. But maybe you're like, hey, I'm okay with that because if GameStop came down to $10, I'd be buying it by the boatload. And so that that would be another interesting way to do it. This one you wouldn't gather nearly enough premium for it to be worth it. Right, like you're getting $6 for every $1,000 that you have to put up as collateral if you're selling a cash secured put. If you're selling naked puts, you got to be super careful. Not something I would recommend unless you're highly advanced. And even then, if you're highly advanced, you should be, you'll have your own strategy formulated anyway. But here, right, you get enough premium where it's like, okay, that's a decent chunk of premium. You're 10xing, 20xing the premium, and only moving up the option chain by double, right? So you're doubling here. So instead of having 1,000 in collateral, you have 2,000, but you're not going from $6 to $12. You're going from $6 to $115. So that's where I really like GameStop right now. And again, if I saw it fall back down into here, I'd be buying up like mad to get ready to sell covered calls. If it starts basing here, I'd probably consider dollar cost averaging in another 100 shares around 35, 36 area. But I'd be really hesitant to do so because unless I could get it in lots of 100 and then immediately sell covered calls on it to remove some downside risk, right? So if I bought 100 shares right now, probably what I would do is I would immediately turn around and I would sell like this call 40 for $900, because what that does is I get 100 shares at $37 a share. Well, minus 9, that brings my true cost down to $28. So if by next Friday GameStop drops to $28, I'm break even, right? And it very well could do that. It could just massively go up again, or it could pitter around, but I've protected myself against some downside. If it does go up, I have to sell at 40. Well, I make $300 there from buying at 37, selling at 40, and I made $900 already. So $1,200 on a $3,700 investment, or $3,700 trade. I really like that play as well. Not as much as the puts right now, but I like that play. If I were to buy more GameStop today, I would be immediately selling a call 40 or something thereabouts on it. Now let's take a look at AMC, because AMC is a little bit different of a case since it had a much broader sell-off after the meme craze than GameStop did, right? GameStop kind of finally found a base for itself. AMC unfortunately did not, due to primarily they had a lot more debt, and it was high interest debt, and CEO Adam Aron chose many times, anytime AMC started rallying, he would choose to sell shares at the market in order to raise money and pay off debt, which is it can be a savvy financial or a savvy move for the business, right, long term, but it's not necessarily great if you're looking to get into a meme stock company that's going to go to the moon, because by him selling a bunch of shares, it is going to dilute current shareholders and also drive the price down. In addition to that, there's this 10-for-1 reverse stock split, which caused a lot of heartache. So if you take that reverse stock split out, right, then AMC, if you're trying to remember historically 3 years ago, this wouldn't be $5 at AMC, this would be 50 cents, 55 cents, right? You had a 10-for-1 reverse stock split, so this is 55 cents. It's crazy to me how low it actually got. This would represent 24 cents. AMC at 24 cents pre-reverse stock split. So here's some interesting levels, though, for AMC. Let's zoom back out a little bit, right? So here's the big kicker. This is going to be like the ultimate ceiling. If this breaks, I would be surprised if the price didn't move to $70, $80, $90, maybe even $100. But I think this is going to act as major resistance right here, this $40 price level, because it acted as such good support for several months before that. And then if we zoom in a little bit further here, right? Now what we've got is some additional resistance lines here, here, and here. And then, well, I zoomed in a little bit too far. Let me go in here. Okay, and one more. All right, right here, right? So this $12 line, let me show you where this is coming from. I'm going to come way back over here. And it's right here. Oh, a little bit further. For some reason, okay, well, the zoom in makes it look super funky, but you can see right above this is where AMC tended to be kind of bouncing above before the initial surge, before the big surge on the short squeeze a few years ago. And so that's where I'm like, okay, that $12 range seems to be pretty interesting, and it looks like it's acting as resistance right now. And of course, again, in pre-market, I think AMC made it up to something like $15 or $18 a share before opening at around 12 and then selling off. And I'm seeing this sell-off very similar. I actually bought an extra 100 shares of AMC yesterday at about 6.5, and I immediately sold a covered call on those. And the reason I did that, in fact, let me show you the position. I'll show you why I did that. Let me see if I can open up, because I did this in my Robinhood account. Okay, here we go. So here's my Robinhood account, right? And you can see, oh man, $2,100, right? And I'm down today, but that's fine. So what I did is I bought an extra 100 shares. So I have 200 shares of AMC now. 100 of them are collateralized by selling a covered call. The other 100 I'm just sitting on waiting for another big spike. But here's the call that I sold. And you can see I sold the call 12, and I sold it for, where is my average credit? Right there, $190. Today, I could buy it back for $100. So I just saved myself $90 in downward pressure from AMC, right? So AMC moves down. I saved myself quite a bit of money there. And that option expires in 31 days. And if it expires in the money, I have to sell at $12 per share. But I'm happy to do that. The reason why I'm happy to do that is because I bought at like $6.50 a share. Let's see if I can find exactly where I bought at. 6.87, right? So that would be doubling my money. I'd be happy to get 100% return over the course of 31 days. But on the other side, I bought it, we'll just call this 6.9 for easy math, which means if AMC moves down to $5 per share, I'm break even. And you can see from the price action today on AMC, it actually did dip a little bit below $5 per share briefly a couple times before coming back up. And now we're, looks like maybe going to try to push towards 6 again before the end of the day. And so I like that position, and I would consider possibly adding another 100 shares today and doing a very similar thing, right? So if I bought 100 shares today at, we'll call it 5.7, $570, I could immediately turn around and look at this. These expire in 9 days. Let's go 5.7 to 10. I could make $81 on that, which means if it dips back down to 4.9, I'm break even. And if it goes up above 10, I've basically doubled my money in 9 days. So that's another trade that I'm looking at. And again, if you do this smartly, right? Like let's just say AMC pitters at around $5 to $7 for a few weeks before having another push up. Every single week that I'm selling these, I'm making $50, $90, $100. That reduces my risk. And so then it becomes a lot easier to be diamond hands on the play, where I can say, you know what, yeah, I bought at 5.7, but I've collected $400 in premium so far. And that $400 brings me down to where, you know, if AMC goes to $1.70, I'm still break even. So I can diamond hands that all day. The other way to look at this again is if you want to throw yourself like 40 days out, right? Look at these 40 days out. Actually, you know, the premium's not much better here. I'd look at selling, if I was selling covered calls, if I buy another 100 shares today, I'm going to be looking to sell a call for about 9 days out. Much better in terms of how much premium you're getting per day. So that's what I'm looking at for AMC right now. Also, I think it's okay. I don't think it's great, but I think it's okay right now to just be buying and accumulating, looking for a move back up to 8, and then when it hits around $8, starting to sell covered calls, you know, for 10, 11, 12. And that would be another way I'd look at doing that, is wait till it hits 8 and then sell at 10, 11, $12 per share. So hope you guys found this video useful. That's our update on our AMC and GameStop position. Please subscribe again if you haven't already. We'll continue to update as new information comes out here, but this honestly looks very similar to a repeat of 3 years ago. If you look at what happened 3 years ago on GameStop and AMC, there was an initial surge, right? Here's the initial surge in GameStop. They happened a little bit differently, but here's the initial surge in GameStop up to about, you know, from a buck. Well, I mean, this is reverse stock split, so it went from like $4 to 20, but from $1 to $5, and then it had this nice push up to 10, and then a maddening push after that. AMC was a little bit different, right? Here's AMC. AMC pushed all the way up here from $20 to $200 in reverse stock split. This would have been $2 to $20 at the time, but with reverse stock split adjusted, it shows us 20 to 200, and then a big sell-off, right? Huge sell-off. A few days of pittering around, big sell-off, right back down to where it would have been about $6. Now that's represented as 60. Based there for maybe a little bit of gains here and there for a couple months, and then massive rally right after. So this would be that phase. You accumulate and you sell covered calls to reduce your risk, and then you sell them at a position where you'd be happy if you got exercised anyway. But that lets you potentially capture much more upside potential once you've reduced your risk to where you're like, hey, I'm happy with my reduced risk position. I'm not going to sell calls anymore. I'm just going to wait for the massive swing up, right? Like today, if AMC moved from $5 a share, let's just say to like $500 a share, I don't think that's realistic, but that's a 100-bagger right there, yeah? So let's say you sell enough premium where you've basically completely de-risked your AMC position. You can just hold and just say, you know what, if AMC never hits $500 a share, that's fine. But if it does, I want to be a part of it. And since I've already de-risked my position, I can diamond hands forever. And even if Adam Aaron dilutes us more, and even if whatever happens and we go down to $2 a share again, I can hold forever. So that's what I think of the current situation. Would love to hear your guys' thoughts. Thanks for watching, and I'll catch you next time.